The United States is headed straight for a debt crisis.
The U.S. government's debt has topped $34 trillion for the first time ever.
That is totally unsustainable. We're headed towards a fiscal crisis.
But the question becomes, how does this end? What's the end game? I'm going to reveal the answer to you in 3 simple, fast steps. Step number 1, let's go over these insane deficits. We've got to understand exactly what the problem is so we can know how this will likely play out in the future. So we start looking at a chart going all the way back to 1930 to today's date. On the left, we go from, I forgot the negative numbers. Oh, well, you guys get it. You're smart enough. The red is negative. I forgot to do that when I was drawing the chart. All right. So we have 0 here, and it goes to negative 25%, and then we've got 5% positive. This is the United States deficit as a percentage of GDP. You say, George, why on earth would it go positive? That seems just mind-boggling. Like, how could that happen? Believe it or not, the United States, going back just about 25 years, actually had a surplus. That means the amount of tax revenue coming in exceeded the government expenditures. It sounds completely inconceivable today when you look at what the deficits have been doing. But let's check this out. Going back to 1930, so the deficit as a percentage of GDP, right around 0%. And as you would imagine, the deficits grew during the 1930s. And this makes a lot of sense because this is when the Keynesians came out and said that, hey, we have to have all of this government spending to prop up the economy to get through this depression. But arguably, it made the depression even worse. And then we know what happened in World War II. Of course, the deficits just completely skyrocketed to a point where they were over 25% of GDP. 1950, we had a bit of a surplus, so we pretty much stay consistent, right around 0%. We start to run deficits in the 1970s and the 1980s. But during this time frame, we were very fiscally responsible. Again, as crazy as that is, back in the day, the government ran a pretty tight ship. But then what happened is we had this surplus, like I said earlier, in the late 1990s, and it just went straight downhill to the point where now the deficit as a percentage of GDP is almost as bad as it was during the GFC. In fact, if you look at a chart of the total deficit, it's actually higher now than it was during the global financial crisis in 2008 and 2009. Why is this a big deal? Because that was a financial crisis, as most of you remember, that was going to end the world. So the government had to come in, or so they thought, like the 1930s and spend money like a drunken sailor so the entire house of cards wouldn't collapse. And no one would argue that that wasn't a hard landing or a recession. But now, supposedly, we're in this red-hot economy where the unemployment rate is almost at all-time lows, a very tight labor market. And boy, oh boy, we just had the latest GDP number came out that blew away expectations. But yet in this red-hot economy, we are still running deficits of, let's say, 6% of GDP. So then the question becomes, if the government is spending this insane amount of money right now, when supposedly the economy is doing well, what is it going to look like in 2024, in 2025, if we go into a recession, which is what the yield curve is predicting right now? We could see this go from 6% all the way down to where it was during the cerveza sickness. And if it gets bad enough, I think we could see it go all the way down to where it was during World War II. And this could take us straight into a debt crisis doom loop. Here's what I mean. So the debt, the overall debt, continues to go higher and higher because these deficits are exploding higher as well. Therefore, that's a lot more supply of debt, i.e. treasuries. Well, if there's more supply, you would assume that the price would go down. And there's an inverse relationship between the price and the interest rate. So if the price of treasuries goes down, interest rates go up. This means that the government's interest payment on the overall debt is exploding higher, not only because the overall debt is growing as a percentage of GDP, but also because interest rates are going up. And this makes the deficit go up even higher than it otherwise would have been, which makes the debt even higher, and it takes you right back in to this doom loop. And oh, by the way, we haven't even talked about the unfunded liabilities like Social Security and Medicare, which a lot of studies peg at close to $100 trillion.
Step number 2. So we talked about the problem with the potential deluge of supply of U.S. debt or treasuries coming onto the market. But now let's go over the problem on the demand side of the equation, or at least these are the arguments. And in step number 3, I'm going to give you my opinion on what's most likely going to play out. Keep in mind, my opinion might differ slightly from what we go over in step number 1 and step number 2. I'm just presenting all the arguments to you, and then I'll go ahead and give you my opinion on how this plays out. Okay, so we all know the story as to why demand for U.S. Treasuries is likely to go down in the future. You hear it on the news all the time or on FinTwit social media. It's the BRICS countries are coming out with their new currency, and we're going to lose the petrodollar. Saudi Arabia is going to start selling oil for Russian rubles or Brazilian real or something other than the US dollar. Therefore, demand for dollars globally is going to go down. And if there's less demand for dollars, then there's going to be less demand to hold US debt. And this kind of has this cascading effect where if the demand for dollars goes down to a certain extent, then we're going to lose reserve currency status. And if we lose reserve currency status, that means that there's a much, much smaller percentage of transactions that are settled in US dollars when you look at overall global GDP. So when you look at this overall decrease in demand as a result of losing what economists would refer to as an exorbitant privilege, and you combine that with all the supply side issues that we talked about in step number 1, you see how this could be a complete train wreck. And this could lead to a U.S. debt crisis. But on the demand side, that's not where the story ends. Let's start by looking at a chart from the Federal Reserve. And this is reverse repo transactions on the Fed's balance sheet. So for those of you who don't know how this works, it's pretty straightforward. A money market fund usually will have all of this cash, and they'll say, okay, we think the best place to park this cash is at the Federal Reserve, because risk reward, this makes the most sense. Usually these money market funds can only invest in T-bills or just put it on the Fed's balance sheet. So they put it on the Fed's balance sheet, and the transaction is called a reverse repo. So we look at this chart going all the way back to 2014. We see the reverse repo account then had, anywhere, we'll just call it an average of 100 billion. And then after 2018, for whatever reason, the money market funds saw opportunities or better opportunities, risk reward in maybe T-bills. So they took that money out of reverse repo. They allocated it somewhere else. Then we have a little bit of a spike during the survey sickness. But where this really started to change is when the Fed started talking about and then increasing interest rate, overnight Fed funds rate. You see this money come just flying in. I mean, this is really crazy. We went from 10 billion in March of 2021 all the way up to a peak of right around, let's just call it 2.4 trillion with a T. So we go from 10 billion to 2.4 trillion dollars. There's a lot of reasons why we saw this increase, but we'll have to save that for a separate video. Because what we really need to focus on is a time frame right around June of 2023. What was happening then, if you remember? Well, we had the debt ceiling. And this was a big deal because Janet Yellen couldn't issue as many T-bills as she would like, and therefore the supply of T-bills really shrank, which is maybe one reason why the RRP, or the reverse repo account, went up to the degree to which it did. But the long story short is that Janet Yellen had to draw down the TGA, which is basically the government's checking account that they have at the Federal Reserve, all the way down to $40 billion, which sounds like a lot, but keep in mind her objective was to have 500 or 600 billion in this account. So when the debt ceiling was resolved, call it in June of 2023, now all of a sudden Janet Yellen could issue as many T-bills as she wanted to get that account balance from, say, 40 billion all the way up to 600 billion. So by issuing all of these new T-bills, she's increasing the supply. Well, it goes back to step number one. If she's increasing the supply to that degree, then most likely prices go down, yields go up. But let's actually go over to a chart of the reverse repo rate, and we can see it kind of sidesteps up with the Fed funds rate. And then if we look at a chart of the 3-month T-bill, we'll kind of use that as a proxy for the front end of the curve, or all these bills that Janet Yellen was issuing, we see that it went up, as you would imagine, in lockstep with the reverse repo or the Fed funds rate. But what's interesting is prior to the debt ceiling being resolved, there were many times when T-bills were trading the yield less than reverse repo. Editor, maybe you can throw up some red dots on this chart to point out some of the dates where we saw this phenomenon. And again, this would explain why these money market funds were going into reverse repo to the degree to which they were. Why? They could just get a better interest rate. But when Janet Yellen comes out and floods the market with all the new supply of T-bills because the debt ceiling has been resolved, now all of a sudden, what happens to interest rates or yields on these bills? They go up to a point where they're higher than reverse repo. So going back to the original chart, we see right around June or so, the amount that is in this account goes straight down to where it is today, right around 580 billion. Now, this sounds like a lot, but when you compare it to the amount of supply that we'll likely see in 2024 and beyond, because these deficits are exploding higher, we're going to get to the point, or at least this is the argument, where this 580 billion goes down to where it was in, let's say, 2020, where it was effectively zero. And if it goes down to this level, because all of these $500 billion move into T-bills, once that demand is extinguished, who's going to buy these bills? So the main takeaway is even when we exclude the problems that the demand side of the equation could have outside the United States, when we look internally inside the United States, we see the exact same type of problems. So this could make that debt doom loop that we talked about in step number one even more extreme. Because if there's less demand, then prices go down. If prices go down, interest rates go up even higher, which means the interest cost to the government on their exploding debt goes even higher. That means more supply of treasuries need to be issued, which makes the interest rates go even higher.
Step number 3. So does the end game for the United States look like Argentina, where they've experienced massive hyperinflation? Or does it look more like Japan, where it's just this slow grind down with deflation and lower economic output? Well, let's start by going over the conclusion that most people come to, and that's that the Fed is going to have to monetize all this debt. We talked about the supply-demand problems in step number 1 and 2. So the solution, quote unquote, is for the Fed to take all that debt onto their balance sheet. And let's just review this real quick to make sure we're all on the same page. The government comes and your drunk, insolvent Uncle Sam wants to spend money, deficit spend, like the drunken sailor that he is, not getting enough taxes like they did in the 50s and 60s. So what happens is Janet Yellen, or the Treasury, the government, comes out and issues these treasuries. Well, most people believe that the interest rates would go way up because all this supply is coming onto the market, and therefore to keep interest rates down, these treasuries would have to go over to the Fed's balance sheet, and they would have to print bank reserves in order to buy these treasuries, meaning that there won't be willingness for the entities in the private sector, or let's just say the non-Fed entities, and that would include banks and non-banks in the United States and outside of the United States. But the main takeaway, or the idea here, is that the non-Fed entities won't want to buy these treasuries because they see the writing on the wall. Therefore, the Fed will have to do all of this. And because they're, quote unquote, money printing, creating all these bank reserves, that's going to lead to inflation, which of course makes interest rates go higher. So that would take us straight into the Argentina type scenario. But let's think this through. Let's go back to the chart that we were talking about with reverse repo. And I just drew this here. This isn't anything close to exact or precise. You can probably tell that by looking at it. But let's go back to June of 2023. And remember, this is when the debt ceiling was resolved. So Janet Yellen could come out and issue all of these bills. So all the supply increased, which brought interest rates on those T-bills up a bit. Okay, well prior, and I'm just using round numbers here, these aren't exact, it's just so we understand the concept. Well, prior to them solving the debt ceiling, let's just say for a moment that these money market funds could get 5% in reverse repo. Well, let's just assume for a moment that these T-bills were trading at 3%. Again, not exact numbers, just using these for the sake of the example. Well, this is going to incentivize those money market funds to go into reverse repo. Why? They can get a higher interest rate. The risk reward makes sense. But then what happens when we have more supply come online? Okay, interest rates go up, but they only go up to a certain point. They go up to a level where all of these funds drain out of reverse repo and go into the bills, because now let's say the bills are yielding 6% when they can only get 5% in reverse repo. So the risk reward completely changes. But let's just assume for a moment that this carried a little bit more risk. And at 6%, it still wasn't a good deal for these money market funds that basically I'm using them as a proxy for global liquidity. Okay, well, it would go up to 7%. At some point, the risk reward is going to be very attractive because you can only get 5% in reverse repo. And the entities that have the money or can create the money are going to come in and buy up those bills. Okay, so this, I think for most people, makes a lot of sense. Let's take it a step further. Let's go over the Fisher equation real quick. Super basic, not rocket science. What we've got is just nominal interest rates equal real interest rates plus inflation. You can say it a few different ways, but I think for the sake of this example, that's the easiest way to look at it. And I also want to point out that when we're looking at inflation, or if you want to look at real interest rates and use them as a proxy for growth, we're looking at expectations in the future. Okay, so if, let's just say inflation is running at 1% and nominal interest rates at 5%, well, pretty basic, right? Real interest rates are going to be 4%. But we need to look at this Fisher equation through the lens of an actual investor or an entity that has a choice. Whether I buy stocks, whether I buy gold, whether I buy treasuries, whatever it is, we've got different options out there. Okay, so an investor isn't going to accept 5% if the real interest rates are 4%, or let's say future growth and inflation expectations are also 5%. Why? Because there's risk involved, there's a cost involved, and that investor wants to make a profit. So there's going to be a spread. So hypothetically, let's just say that spread is 4%. That's the minimum that an investor needs to make in order to deploy the capital to begin with. All right, well, then if interest rates are at 5%, what this tells you is that growth and inflation expectations would be at 1%, because you've got to subtract that premium that includes the risk, cost, and profit. So then what happens is we can see actual growth and inflation expectations are 1%. They're not 5%. Okay, well, if growth, let's say, expectations 0%, and inflation expectations are at 1%, do you think there's going to be more demand for treasuries or more demand for equities? Well, the answer is obviously a lot more demand for the safest, most liquid types of assets, and whether we like it or not, those are U.S. Treasuries. So the simple fact that the 10-year Treasury right now is trading around 4%, especially when Fed funds is at 5.25%, tells you that there is epic demand for government debt. It's not a good thing, it just is what it is. But that's not all. We have to remember that this epic demand that we're seeing, or these very high prices for treasuries, comes at a time when the government is, in fact, spending money like a drunken sailor. It is true that the national debt is near or over $34 trillion. It is true that the government is running huge, massive budget deficits. It is true that Janet Yellen is flooding the entire system with a deluge of supply of government debt. But we have to accept the fact that right now the marketplace is not only buying all of this debt, but they're saying we want more. And those are just the dynamics that are in play domestically within the United States. Let's go through what's happening outside of the United States, because their Fisher equation is much different. So let's assume for a moment that you're an investor in Japan. All your expenses are denominated in Japanese yen. Okay, well, if you're considering buying a treasury and the United States dollar is appreciating in value against your local currency, well, now all of a sudden, instead of your inflation rate being 1%, you're actually seeing deflation, meaning the value of the currency that your asset is denominated in is going up in value relative to local goods and services. So if this number goes from 5%, let's just hypothetically say that it goes down to a -5 because the US dollar is appreciating at that rate relative to the Japanese yen, that means that you're willing to pay a much, much higher price for those United States treasuries, because there's an inverse relationship between price and yield. If you're willing to pay a higher price, that means you're willing to accept a lower yield. And keep in mind, this is not predicated upon the dollar maintaining its value relative to goods and services in the United States. This is only dependent on the dollar maintaining its value or increasing in value relative to all these other currencies that have even bigger problems than the United States dollar. And if you think the Fed is going to quote unquote print money, what do you think the Bank of Japan is going to do? What do you think the ECB is going to do? They're going to quote unquote print money to even a greater degree, if that's in fact what the US is doing. So does this mean that, in my view, the United States can continue with these massive deficits and spending money like a drunken sailor, and the overall deficit going up to 40, 50, 60 trillion without having to pay a cost? Absolutely not. But the cost might not be a debt crisis. The cost that we're going to have to all pay as a society is the fact that the government is spending that much money to begin with. To understand what I'm referring to, editor, let's cut right to the internet.
Let's look at a chart of government spending as a percentage of GDP. So this goes all the way back to 1804, by the way, and it goes to 2018. And during the Civil War, in fact, each war, Civil War, World War I, and World War II, we see that this number just goes parabolic, just spikes straight up, as you would imagine. The government spends more and more and more relative to the overall economic output of the society at large. But what I want you to notice is every single time government spending spikes like this, it goes back down, but it never goes back down to the same level. And this is very clear when we look at World War I and World War II. So prior to World War I, government spending was, let's just say, right around 10, 8%, something like that. Afterwards, it settles down around, let's say, 15%. And then we look at World War II. Oh, and by the way, Great Depression, exact same thing. Government spending goes through the roof, and it comes back down slightly, but at a level far higher than where it started. And then we have this big move up. World War II comes back down, but it comes back down to a higher level and keeps growing and growing and growing. Okay, so why is this a big deal? Okay, well, if we just use some common sense, if I asked you what is going to be more efficient, the government or the private sector, most of you are going to say the private sector, hands down. Okay, so if the majority of your economic activity is coming from the private sector, you would assume that that economy is going to be far more efficient. They're going to create more goods and services, which at the end of the day is the definition of wealth. That's how the standard of living for society improves. Now let's go over to a custom chart that the Rebel Capitalist team made just the other day. I want to highlight this yellow line, and this is real GDP. Now, I know this isn't a perfect measurement, but we can use it as a broad proxy for the standard of living improving or improving at a lower level. So what we see is back when government spending as a percentage of GDP was very, very low, real GDP right around 50%. And then what happened as the government spent more and more and more, real GDP, or the efficiency of the economy, declined, as you would expect. And then, oddly enough, in World War II, it went way up. Now, I think this has a lot to do with price controls, but we'll save that for a separate video. But since that time, what has it done? It's gone straight down to a point where from 2000 to 2010, real GDP growth for the entire decade compounded was 15%. Now, that might not sound like a big deal, but I'd like to also point out that during the Great Depression of the 1930s, real GDP growth was 10%. So 15% isn't a far cry from 10%. So if you want to say that the Great Depression was catastrophic at 10%, what were the early 2000s at 15%? So the main takeaway is we are definitely heading towards a debt crisis. But the debt crisis isn't that there's no demand for our debt. The debt crisis is that the government is spending more and more money, which distorts the economy, which makes the economy less efficient, which disproportionately negatively impacts the poor and middle class. It's just like the heroin addict that puts $100,000 on his credit card buying drugs. It's not that he has a debt problem. It's that he has a drug problem because you can give him a brand new card with a $100,000 limit, and the problem is only going to get worse. So is the end game that the United States turns into Argentina or Japan? Well, I think it's going to be a little bit of both, just like the 1940s. In 1947, the inflation rate in the United States was 19%. And then 2 years later, it was -2. So within a 2-year span, 3-year span maybe, in the 1940s, we had both Argentina and Japan. And I think that's exactly what we're facing in the United States throughout the rest of the 2020s.